I want to kick off my first question with just how the funding models have changed in the bridging market over the last 2 years or so. In the beginning parts of 2019, the Bridging and Commercial magazine ran an article on funding models in bridging, and it found that 40% used high net worth, private and family office money, and then 44% used wholesale facilities. So it showed that there was a bigger appetite from institutional capital in this particular space. Do you think that the funding models have changed since, and how and why?
So I think the construct of high net worth and wholesale funding has remained the same, and the optionality around those, both of those funding sources. I think probably what we've seen is just a bit of a diversification of the use of both. So a number of funders that we've worked with and that we have seen in the market now use both rather than one or the other. I think we've probably seen a change in where that high net worth funding is used. So I think previously we'd seen that used as funding the whole of the capital structure and help support that. We've seen a move that high net worth funding now is a junior participant in any funding structure and helping from that perspective, and a wholesale funder has stepped in and taken some senior positions. And then I guess we've also seen the emergence of forward flow or whole loan sale as a part of that wholesale funding piece. And yeah, that's been a real marked change. I think probably from when I think back to 2019, we hadn't seen that many forward flows within the marketplace or whole loan, and now I think probably 1 in 3 new opportunities that we see are of that construct. So I think that point around just diversification and use of all those kind of different capital sources is probably the big one. And then also the emergence of kind of the iBanks coming in to lend in that wholesale part of the market. We've seen JP Morgan, we've seen Morgan Stanley, we've seen Credit Suisse come into the market. And that's an important, I think, rubber stamp for this market, that it's institutionalised and the wider FS market is sort of standing up and looking inwards. So I think that's great.
Yeah, I think it's fair to say many started with high net worth funding, and actually as they grew, had greater funding needs, that they really kind of moved into wholesale as well. And so that kind of move from larger proportion high net worth to large proportion wholesale just makes sense. And I think you just keep seeing that progress. Having said that, I do think that diversification of funding point that Stuart made is really important. We've seen many people hold on to their high net worth as well as wholesale.
You mentioned a little bit earlier about forward flow kind of increasing. I think you said 1 in 3. Is the demand coming from the forward flow funders, or is it the actual bridging lenders who are seeking out this type of finance structure?
I think it's probably a combination of both, from the purchaser of the assets or the forward flow provider. We've seen a big influx of new money around the kind of asset management hedge fund community, looking to put money to work under a credit strategy and looking to purchase these loans. We've also seen a number of the challenger banks within the market looking at ways of increasing origination into certain markets and using kind of bridging originators as a way to do that. And then I think there's just a greater understanding of the product on the originator side in the bridging market, and as a way of kind of growing a business, but not necessarily on balance sheet, and then thinking around how they as an equity light option within the marketplace. I think it's a combination of the both, but there's definitely a greater appetite out there than there's ever been.
Yeah, I think it's back to that diversification point. How many different ways can I finance my business, and does that give me protection against any of those falling away in the future? I think that's been an important element of the emergence of forward flow as a funding strategy for these businesses.
And you've mentioned quite a few of them already, but are you noticing any new or different funding structures being used in the bridging market, and what benefits does this provide lenders?
So not necessarily any new funding structures. In fact, forward flow, whole loan, wholesale, they have been around for a long time. I think we saw the options definitely significantly thin post credit crisis, and I think actually it's more so the number of different parties out there that originators, bridging funders can use and partner with that has actually changed. Yeah, it's only probably every week we see a new funder enter the market, and not just your traditional kind of UK, US optionality, but we're starting to see a lot more kind of European and actually just global institutions look to the UK as an option of deploying capital.
And you mentioned earlier, we're seeing quite a lot of big names enter the space as well. Like JP Morgan, for example. What has been the upside and downside of more institutional debt and big names like this in the bridging market in terms of unique offerings and margin?
Yeah, so I think like the upside is, and I think I mentioned this before, the institutionalisation of the market and the ability for the market and people to take notice of the market externally has been a huge positive. I think bridging finance has become more of a vanilla offering, and I think that has gained a much wider audience, which can only be a good thing from a business development and growth perspective. And we've seen the market grow significantly as these things have moved on. It's also given a number of clients a real ability to grow, and not just grow in bridging markets, but then also grow into other adjacent markets, which is a real positive. I think negatives, and I think you might have picked up on the kind of pricing and product point, is that whilst there is some differentiation between different funders in this market, there is also a minimum standard on products. And I think what I would like to see more of is a number of those funders looking into, for example, more development style products and giving originators within this market optionality and helping them to be able to grow. And I still think that there is a lot of structure and bureaucracy around a lot of these facilities, and so just making things a little bit easier for originators is something that we're really passionate about, and taking some of the complexity out of these structures.
Yeah, I think downside wise, depending on where you sit, these bigger names, bigger funders are normally attracted to the bigger lenders, and so what you may see over time is just that gap widen between the terms that a very large bridging lender can provide and those that are a bit smaller. And as those facilities get bigger and in theory cheaper, that gap potentially could widen. So I think that's probably the biggest downside, but it depends on which side of the fence you sit, right? Whether you're a larger lender or a smaller one.
Sure. Do you expect that, obviously, with that gap happening, the mid-market in the bridging space, will that start to become more underserved?
I think in terms of, it's difficult to talk about mid-market. I mean, we've always talked about it as being by size of bridging lender. So you've had the very large ones, and then there's been a bit of a gap, and then kind of a quite a long tail of smaller lenders, and that mid piece just seems quite empty, to be honest. And I think it probably gets harder and harder to leap from being a small bridging lender to a bigger one as those facilities just get better and better for those larger lenders.
And you mentioned as well that you hope to see more funders offering facilities for bridging lenders to offer a development product. Do you see appetite from funders to do this? Are you kind of seeing a bit of movement here?
We are. It's still limited, I think, and just as when I believe bridging became a little bit more mainstream, people started to understand that product. I think we're on the same journey with development financing, probably sort of 2 or 3 years behind bridging in terms of that understanding. So there is some movement, but I think we would like to see some more. And I think, speaking to our clients, they would like to see some more as well. We think that will help the market, and we think there's some growth there to be had as well.
I wanted to talk a bit about your latest survey that we published in the Bridging Commercial magazine, the last issue. It found that 46% of bridging lenders are considering raising equity capital, and 50% think institutional funding will increase over the next year. What do you think, what do you expect to happen if this continues on this upward trajectory?
Yeah, it's difficult. I mean, the market needs to grow to accommodate, and if it doesn't, what happens is you just get more competition, which I think for the end borrower, in theory, becomes a good thing because pricing goes down. But it becomes a lot more difficult to compete in the market because more liquidity coming in, market not growing as quick. It becomes a lot more challenging to compete in the market.
Yeah, it kind of ends up with this race to the bottom, which has been a topic of conversation for the last few years. And what are lenders' USPs and what are they really offering that's new? Because like you guys have said, you're seeing new people on a weekly basis, and we're also seeing new lenders frequently, even during the pandemic. So it is kind of seeing what they're offering that is new and how they can actually compete to be sustainable. So that'll be quite interesting to see how that changes over the next year or so, especially if they're looking at more institutional funding. Because I saw something or read something recently, about how lenders who are trying to offer everything like the life cycle lending proposition, and whether that's kind of moving a bit more away from what bridging really is. And I know you talked about it a bit earlier about the mainstream bridging offering. It's becoming more vanilla, which is great. It's helping more clients which need that type of offering, but we still need those lenders who are very nimble and offer the very specialist complex products. So it will be interesting to see how that kind of emerges, but I do agree with you. I think we're going to see this kind of fragmentation of the market, even not worsen, but you'll see it more clearly.
Yeah, and I think your point around people increasing the number of products they offer, we're seeing that a lot at the minute, and a lot of it's really targeted at pushing out the term. So before it was a up to 12-month bridging product, now 3-year kind of bridge to let, and so we will continue. We think we'll continue to see people look to offer numerous additional products, and some of that's all aimed around keeping the customer for longer as well. So can I help fund your land, then develop the property on the land, and then bridge the sales, and then finance the buy to let, and really seeing how they can help that client through exactly that life cycle of their transaction.
I think the other point as well, you talk about sort of speed of service as a USP, which has been the fundamental of bridging finance, and I think therefore there lies probably an opportunity actually, as the larger originators grow into that kind of multi-product piece and see themselves possibly on a different model, that actually just pure bridging businesses, there is an opportunity there to continue to serve that market via kind of service and speed, which still remain important, and we have seen that, and a number of people that we've spoken to as well have seen that. So I don't think necessarily everyone is in the race to the bottom, and I think some people are actually seeing it as an opportunity to kind of diversify themselves, but in a different way, and keep into that kind of the truities of the bridging market.
We're also seeing more bridging lenders offer regulated bridging now. Are you seeing more funders interested in that segment of the market?
Yeah, we are. I think actually the funding market has taken that as a positive, just with the extra regulatory oversight that's involved within that kind of product set. And actually, we think for businesses to have been through that process to gain the kind of regulatory approvals is also a real positive, when you're looking from a funder perspective as well. So we haven't seen as much pushback at all from lenders in there. There's some at the start, but I think it's becoming just a more and more vanilla product, which is good to see.
And then there was another figure on the EY report, which was about M&A. I think it was 31% of the bridging market are considering M&A opportunities. Considering the market that we're in, where it's quite uncertain and volatile, do you foresee much activity in this respect over the next 2 years? And what sort of companies would be interested in purchasing a bridging lender right now?
Yeah, so not surprised to see that number, that kind of third of businesses looking to potentially undertake M&A. I mean, if you think many of these businesses started really out of the last financial crisis, and therefore, they've been running for whatever kind of 13, 14 years. So, there's definitely a number of them where they'll be thinking about not only exit, but actually raising capital to grow further. So we think that makes sense. Look, it's a business where it has typically good risk profile. So you're lending 60-70% loan to value against UK property. That's got a great risk profile, and the returns, despite them coming down, have continued to look very good, certainly relative to some other asset classes. So you'd expect that there should be good interest in bridging finance companies from external investors. I think the difficulty is really the short-term nature of the product, and that's partly why we've seen people really look to push out. And so I think anyone looking to sell really needs to focus on, how do I look different to the other bridging lenders? How can people see me as a business with longevity to it? Am I purely just a price taker, or do I have a brand in the market that people go for and trust, and have a strong repeat client base? So we think bridging finance companies will be attractive to a number of investors, but they really need to kind of get over those challenges and really tell their story as to how they can deal with those.
Do you think they'll be more sellable if they are, offering the life cycle lending proposition, like you said, because of the short-term nature of their books, it might not be as interesting to someone who wants to buy it?
Yeah, look, I think it will differ from buyer to buyer. So, I mean, if you look at some of the banks, they struggle because of the high capital cost of development. Bridging still has a relatively high capital cost, but not as high, and that may make it more attractive. So, whereas private equity might be interested in that whole life cycle lending, and actually any other products you can bolt into it to almost create an ecosystem where a developer can go to. So I think there will be different buyers depending on structure, and I don't think it's build out as broad as you can, and they will come. I think there will be different buyers for different types of businesses.
The fundamentals don't change though, in terms of looking at the underlying business and making sure that if you're looking to sell your business, that you are fundamentally as good as you can be in things around data, process and procedures, collections and all that kind of good stuff, because that really is important and is a great driver if someone's looking to buy your business. Making sure that you've got that right, as well as kind of the other USPs. It's that kind of fundamentals that continues and will always continue, I think, when you're looking to buy or sell a business.
A few years ago, there was quite a lot of talk about the specialists or challenger banks looking at buying bridging lenders, but we didn't really see that come to fruition in the big way that people were talking about. Do you expect that to kind of pick up again, or to change in the near future?
I think I don't think it was just bridging finance companies. I think challenger banks, weren't focused on making acquisitions, over the last few years. I think they enjoyed very strong organic growth from either bringing in teams or just expanding the products they already had. We feel like that's starting to turn slightly, and there's been a number of businesses that have been acquired by challenger banks, and we think for the right business that there could be interest from them, but I think it's at the turning point rather than turned at the minute.
Thank you both for your time. We really appreciate it. It's been a really interesting conversation about funding models, and I'm sure our readers will be really keen to hear your points of view.
Cheers.
Cool. Thank you.
Thanks.